Thank you for joining us. Day 4, but it feels like it's been 4 weeks or so of Climate Week. Lots going on. So we are very glad you're joining us for, frankly, let's just say not the sexiest of titles, to put it mildly. Cement and steel, systemically important, crucial to the climate solution, decarbonizing a fifth of global emissions, right? Cement, 5 to 8%. Steel, iron and steel, mostly iron. We'll get into the details. Maria, you get to play cleanup after what I'm saying now here. At least 10% of CO2 emissions. And hard to abate, right? Power sector has more emissions overall. It does. Somewhat controversial thing to say, but we are solving that problem. Or at least the sort of barriers that are standing in the way. Not the topic for today. And yeah, exponential growth on solar PV, batteries minus 50% in the last 18 or so months. I think this is from a month ago, so in the last 19 months, minus 50%. Huge changes, big progress, and, well, solar PV is the cheapest form of electricity in history and has been for a while. For commodities like cement, iron and steel, there is this persistent green premium, has been, and we'll get into some of the details of, in many ways, what are the prospects of solving that through economics alone in many ways. Co-production, valuable alumina being produced while also producing cement, for example, or being situated in Europe, where some of whatever is happening here politically at the federal level may in fact not apply, does not apply as much as it does here. So the conversation today, industrial decarbonization in a rapidly shifting policy environment. And we are lucky to be joined by 4 practitioners and experts on the topic. I'll start with Simon Brandler, General Counsel, Acting General Counsel, lawyer by training, Columbia Law School, by the way, essential to mention, and the VP of Policy and Public Affairs of Brimstone, one of the leading low-carbon cement companies. And we'll get into some of the details of cement production and the policy aspects over the course of this conversation. But first, I'd like to turn to Maria Persson-Gulder, founding CTO, Chief Technology Officer of Stegra, formerly H2 Green Steel. You can tell us why it's not just steel, it is in fact iron, and why iron matters more. Stegra is perhaps the leading green steel startup, and despite Spotify and Candy Crush, perhaps the most important Swedish startup. Not just with climate, but more broadly at green industrial policy in Europe, writ large. Before Stegra, she was at McKinsey, left as a partner. You have a PhD in applied physics, I believe, so you can definitely tell us about the technical details. I won't ask you about you being a professional golfer in your prior life, but we're very glad you joined us, flew in today to join this conversation. Nick Ellis is a principal at Amazon's $2 billion climate pledge fund and managing the investment portfolio and strategic relationships with climate tech as the primary, only focus. And before that, you managed a $1 billion industrial innovation fund at Amazon, an investment banker by training. So this is your home turf, business school. And Cornelius Pieper, senior partner Managing Director for Climate and Sustainability in BCG's Industrial Goods Practice, based in the Boston office, and in many ways, the sanity check, perhaps, for the rest of us, because your clients go across the spectrum, right? Not just the startups, or maybe not primarily the startups, but the big industrial players. We'll turn to you. I'll turn to you frequently for precisely this sanity check. But actually, how about this? This is, in fact, a bit of an unusual topic. So, as a first step, Maria, can you tell us a bit about the technology? Why steel is this problem? Why iron is the problem? And the main solutions.
Would be happy to. So just as you mentioned, steel is about 10% of the global CO2. And the interesting part with steel is that almost every big economy actually have their own production in their nation. And there is actually two types of steel. There are many types of steel, but if we simplify it, you have long steel and you have flat steel. Long steel is mostly scrap-based, while flat steel is mostly iron ore-based. Because when you make steel, the big compound that you need is the iron. And iron ore, if we take then just the steel steps of actually making steel in the flat space, which has most of the CO2, then 80% of that in that production actually comes from the iron making. So there you have the actual number. The rest is mostly then afterwards when you have made steel, you make blocks of steel, and then when you're going to roll them out and have them as coils, you heat them up. So there comes some CO2 as well. But if you focus then on the iron making, iron ore that you dig up from the ground is actually oxidized iron. That means that oxygen is connected to the iron. And if you want to separate that in order to get the iron, you need to reduce it somehow. Most places in the world uses a blast furnace to do that. So you use coke and iron ore, and you get out iron and you get out CO2 because coke has a lot of coal. There is an alternative that is used across the world, and it has been used for 60 years or so it's well-known technology, and it's called direct iron reduction. That is using natural gas in order to reduce the iron ore. And if you look then at the technology, you reform the iron ore into carbon monoxide and hydrogen. And both those gases are reducing the iron ore simultaneously, and they depend on each other. So the carbon monoxide is in chemistry called exothermic reaction, so it gives away heat. The hydrogen is endothermic reaction, so it requires the heat in order to reduce the iron ore into iron. The carbon monoxide, when it reduces, creates CO2 and iron. The hydrogen creates water and iron. So if you take only hydrogen to reduce the iron ore, which you can do, you need to give it energy. So using pretty much the same technology that has existed for 60 years, but feeding it with high temperature hydrogen that you can produce in a green way, then you reduce the CO2 emissions by 100%. What's also interesting is that that is actually a much more efficient reaction. The hydrogen is about 10 times faster than the carbon monoxide reaction. So in the end, as long as you can get economic efficiency out of your process, it's a better process. It's a more clean process, not only for the CO2 emissions also, because natural gas also have a lot of other components that will then get trapped into the steel. So if you only use hydrogen, you have a cleaner iron and therefore also a cleaner steel. So at Stegra, what we actually do then is that we are currently building a facility that is supposed to produce 2.5 million tons green steel. We're reducing the whole steel production with 95% when it comes to CO2 emissions. Still some CO2 because you can't make steel without carbon, and that creates some CO2 emissions across the production still, but 95% is quite a big reduction. We have green hydrogen produced by electrolyzers, where you take in water and split it with green electricity and get hydrogen. And you feed that into then the direct reduction iron tower that we have. We have a 2.1 million tons of DRI that is coming out then, that is the iron, and that is feeded into the process, producing 2.5 million tons of steel.
And you need a lot of energy, a lot of electricity.
We do.
Which is one of the reasons why you're in northern Sweden, because electricity is cheap.
Correct. We have hydro power in the north of Sweden mostly, that comes at a very, very cheap cost. We have electricity prices that are below 30 euros per megawatt hour, which is about the cheapest that you have in the world. And it is a large amount of hydrogen power that is produced every day that gets trapped up in the northern region because we don't have good enough transmission lines to get it down to the south. So you can have energy prices changes that are very, very big difference in the north versus the south of Sweden.
We'll get into much more of the commercial side in a minute. May I ask you to give us the cement equation, the chemistry of sorts. So basically, not just brimstone. Brimstone has a very particular way of doing this. But where is the CO2 coming from? Because it's not just the energy you need, right? It's actually in the calcination process, in the very chemical equation that produces the cement.
Right. I mean, this is one of the most surprising things for folks who, I say, fish can't see the water, we can't see the concrete around us because it is the most consumed man-made material. It's literally the foundation of the built world. But by the time we see it, the climate problem has already occurred. And that's because in the production process itself, it starts with limestone. Limestone is calcium carbonate. And so that carbonate part becomes important because in addition to requiring heat, which is usually created by burning fossil fuels, often the cheapest form of fossil fuel, coal, but even still, that fuel is only responsible for about 40% of the overall carbon emissions of cement. The remaining 60% are process emissions because when you heat up that limestone, that carbonate off-gases as CO2. And so, this is why traditionally cement has been considered a hard-to-abate sector, because even if you found fully renewable heat in some way, shape, or form, and I'm not saying that's an easy problem, you'd still, if you wanted to make the same ordinary Portland cement we've been using for 200 years, you'd need to figure out how to deal with those process emissions that are part of the chemistry of the whole process.
What does brimstone do different?
So brimstone, realizing that the problem was the rock, the feed rock, uses a different rock. We use calcium silicate rocks. They are abundant at the surface of every continent. In most countries in the world, they can be located close to where the end users are, which is quite important with cement because it is heavy and it is expensive to ship. And so what we do is we elementally separate the calcium silicate into its elements. And from the calcium, we make ordinary Portland cement, the exact same cement we've been using, for many, many decades. But what makes it work and what makes the economics work is that the calcium carbonate-based process is quite simple. You just put the rock basically with some gypsum, with some other things, but you put the rock into a kiln and you heat it up. And, you grind it and you essentially have ordinary Portland cement. But the calcium silicates they don't off-gas the silicate. So you have to figure out something to do with the silicate part and with the aluminum and some of the other elements that are in there. And so Brimstone's breakthrough was around co-production. So instead of just making ordinary Portland cement, we make ordinary Portland cement. We make another concrete ingredient called supplementary cementitious materials, which is also important for decarbonization reasons, which I can go into, as well as alumina, which is the main feedstock for aluminum.
And aluminum is pretty valuable, and that pays for all of the rest?
Yeah, I mean, the idea is that in industrial scale, this 3-product co-production process will be able to sell commodity products at commodity prices. So that's the goal. The goal is to get to a point where you don't need to be green in order to buy our decarbonized cement. You just need to want cement.
Which might be the time to turn to someone who is buying that cement from Brimstone, Amazon. Are you doing that out of, basically, is it charity? Are you paying extra today because it's the right thing to do? Or is it basically, right, you're helping climb the learning curve, slide down the cost curve, and you get your hands on some of the first low-carbon cement, and presumably lock in the cheaper version down the line as well?
You nailed it. Is this on? Coming through for folks? No. Sorry, there we go. Hopefully that's a little better. Sorry. You nailed it. It's the latter. You know, if anybody's shopped at Amazon, we don't advertise high prices, we advertise low prices. And it's the same, and it's driven by our attention to cost and detail inside the business. So we will not be a large-scale off-taker of anything that is at a high premium over a long period of time. It doesn't align with our or most businesses' business model, in my experience. I think one of the unique things about Brimstone and essentially every company that we invest in is they have to demonstrate a path to cost parity. If we can't believe that at the time of investment, we'll watch, we'll learn, we'll wait and see if there is an opportunity, but that is a predicate for us to be able to invest. So everything we do is to try and scale up and cost down these solutions in a way that not only serves Amazon, but other customers out there as well.
But it's called the Climate Pledge Fund,
Yeah.
right? So, I mean, there's some climate in the background. You're doing it because like you might be searching for the cheapest opportunity, but it's, you know, green tinged glasses guiding you toward that.
Yeah, I probably should have set the stage. So back in 2019, Amazon committed to be net zero by 2040. That means neutralizing our scope 1 through 3 emissions across all our business units, about 300 of them today. We believe many of those solutions actually exist today. Electric vehicles are probably the best example. One of the first investments the Climate Pledge Fund made was in Rivian. I don't know how popular their commercial cars out here, but their EVs now number about 30,000 in our fleet, and we intend to grow that by orders of magnitude. These are economical today, and even though it was one of our first investments, it really was more of a proof of concept that we could invest, scale up, and cost down this technology because that was readily available there.
Yep.
But many of these technologies that we need do not exist today. That was the reason we put the initial $2 billion to work and took longer term bets like Brimstone. We have a green steel investment called Electra, close competitor and colleague, I would say, as I understand it, of Stegra. And each of these we recognize will take 10, 20, 30 years to scale up. And we need to be that catalytic customer today. That climate pledge commitment now includes over 600 other corporations, Procter & Gamble, Microsoft, MasterCard, et cetera, that similarly have agreed that they will make a similar commercial commitment to offtake and decarbonize their businesses. And so we really hope to lead that conversation and convene that conversation, but it is not solely for our benefit. And we certainly take more than just a green tinted view of it. You know, we take a hard economical view of it as well.
Cornelius, so hyperscalers are deep pockets, fast growing, a big part of certain aspects of this, but the cement industry, the steel industry are much larger than, you know, just Amazon, just Microsoft, which just signed a contract with Stegra this week, I think, right? Microsoft. Or
Yes, they did. Yeah, correct.
how do you articulate this value proposition for low carbon cement of any kind, low carbon steel of any kind, to your industrial clients, to the big players?
A couple of thoughts, also kind of reflecting on what we've heard from the previous panelists. This is still very early days in many ways for some of those technologies, and I think there's a fascinating kind of pattern around technology adoption, which is it's slow until it isn't, or it's new until it isn't. And that goes back, I don't know, you can look at railway, or you can look at telephone in the end of the 19th century, or light bulbs, or all these new things. They start, they're really expensive, they're maybe not working on it, not as efficient, hardly anybody has them, etc., etc. And then over time, stuff happens, and then suddenly it goes really quickly. And we've seen this with solar, we've seen this with electric vehicles, etc., etc. You all kind of are part of it, and you're in the middle of it, of how quickly these things evolve. I mean, also consumer products. I mean, the first iPhone and the current iPhone, they're like worlds apart. They're also a little bit more expensive, fair, but still, I mean, the progress is quite tangible. So that's one thing, and we need to keep that in mind, that we look at this and it's difficult and it's maybe not working perfectly, and how is this ever going to function? That's typically how it starts, but that's not how it continues, right? So I think that's one thing. The second thing, which I think is actually fascinating, it's great that you're here, Nick, because a few years ago you wouldn't have thought of Amazon as someone who buys cement, or of Microsoft as someone who buys steel. And essentially, I mean, you're not building the plant or the factory yourself. There's people in the middle, which typically would be the ones that buy cement. Which also, I think, brings me to my next point regarding also the value proposition and why do people do that, or why does it make sense? So if I'm a construction company that kind of has a project to build, and it's narrow margins and time pressure, and you have maybe not the right people that you need, or not enough, or whatnot, you're in no position to pay more, to experiment, and all these things. If, however, you find someone 2 or 3 steps down the value chain who has a bit of a different perspective on this, who has a strategic interest that you articulated, who maybe also has the funds available to help some of those technologies, it's a very different equation. So expanding, in a way, the sources of demand by going down the value chain is super important. And the other effect that comes to bear there, and I think steel can be a good example for that. So when you produce your steel in Boden, it's more expensive than conventional steel. I don't know, I'm guessing 50%, whatever it is, doesn't matter. But it's more expensive in an extent that makes it hard for the direct buyer to really swallow that or cover the cost. But if you think about that steel, flat rolled, long, flat steel, the coils go, I don't know, to Electrolux or some capital goods, consumer goods company making washing machines. And then the washing machines get shipped, and there's some marketing happening, and this and that and the other. And then you find the washing machine in the store or at Amazon, I don't know. And the final consumer price of the washing machine, say $1,000 or €1,000, the cost share of steel in that washing machine is not very large, because there are all these other factors. And the cost increment of having green steel in that washing machine is actually really small. And if you do the math, and you can have long discussions about it, it's like a couple of percentage points. So to say decarbonization, even of the hard to abate sectors, is too expensive and not affordable, I don't think that's correct. It's more the question kind of how can you basically create mechanisms that help, I don't know, call it share the burden, or to kind of distribute it, those costs, a little bit more equally. Because basically the issue we're dealing with is most of the emissions in many of the products we're using occur at one or two process steps very high up in the value chain, very early. And then the rest doesn't really add that much. So to say the costs for decarbonization should sit only there and should be borne only by those upstream, that's not necessarily the right answer. So then the question is, how can you get more Amazons to kind of look at it that way? And I think that's starting. There is more and more, I've had a bunch of conversations this week where companies are in a way also waking up to the potential risk of being shut out in buying those low carbon materials, because demand can shift quite quickly. Supply is not so easy to shift, because basically what isn't FID'd by now is not going to be producing 2030. Pretty simple. And then there's stuff, we did an analysis about SBTI commitments, and you can debate, is that the right measure? But many companies are making SBTI commitments. And if you look at when will these commitments in a way come due or have a certain deadline or milestone, there's like many. I think of the 10,000 that there are, there's like 7,000 coming due in 2030. So a lot of people need to start thinking pretty seriously of what they're going to do. Some are going to say, okay, fine, we can't do it. I don't know, it's too expensive. We give up. But many will start looking around, and then suddenly there's not all that much, because there aren't so many steel plants like the one in Boden, because that takes a long time and a lot of money and a lot of work, etc. So that sinks in slowly.
Hashtag FOMO, right? Fear of missing out.
Totally.
SBTI 2030 effect. Sort of there's a target, somebody set a target, committed to a target, and yeah, there's only so much green steel to go around, or low carbon cement to go around. And then, so Stegra has a fairly unique investor profile, right? A set of investors. Like you don't just, in your case, right, much like Amazon and Electra, being an investor in the product, Mercedes holds an equity stake in Stegra.
Correct. Yeah, so to put a lot of color, what I absolutely agree with when it comes to Stegra, when we started and looked at this project, it actually is the fact that if you look at Europe, you look at the cost of producing the green steel with our production steps, it is actually not more expensive from an operational cost perspective. We are at the lower side of a very flat cost curve. Now, cost curves is a very basic material thing to look at for industries, but they're very, very interesting. It means that all the industries are pretty much having the same